I'm Mike Coyle, and you're watching Insidexploration. Today I'm here with Paul Huet, Chairman and CEO of RNC Minerals, listed on the TSX under RNX. Paul, thanks so much for taking the time to talk to me today.
Yeah, good morning, Mike. It's a pleasure to be here. Thanks.
Glad to see you're doing well in light of the recent pandemic. Hope everything is on the up and up down in Australia.
Yeah, look, same for you. I hope that all our listeners are doing well, and everyone's doing whatever they can proactively to get through this. It's a very different time, trying time. It's been challenging for many of us. In fact, actually, before we dive into the interview, maybe I'll just talk quickly about COVID and our situation in Australia. We were one of the first mining companies to be very proactive and hire a doctor and a nurse to bring them on site. One of the things that I've been really bragging about for the last several months was the hiring of Graham Sloan, who changed our turnover rate from 87 down to 16%. But when he was doing that, Mike, what he did was he actually started hiring a lot more local people. So at our Beta Hunt mine, where we used to be 80% of our workers fly in, fly out, 20% were local, we now have a ratio of 70% of our population that are local and only 30% fly in, fly out. So that has helped us tremendously through this pandemic. And at our Higginsville operation, we're continuing to hire more local there. We still have a larger group of fly in, fly out there, but we've taken an extra step there besides the doctors, and we've actually chartered our own airplane there so that we can ensure from the beginning to the end that we know where people are, and we're protecting our people, our contractors, and avoiding any risk of bringing anybody infected to the mine site. So very different times, challenging times, but I hope, again, all the listeners are healthy, safe, and we are certainly being extremely proactive during this time frame.
Yeah, I got to commend you on your efforts. I mean, you guys had to deal with the fires that were burning in Western Australia and now the pandemic, and it seems like it hasn't slowed you down one bit. I mean, the last 2 weeks especially, you've put out a flurry of news. Maybe you could just give us a quick update about that before we dive into HGO?
Sure. And look, all these steps that we're doing have been very strategic. They've been some of these things we've been working on for months here now, and they've always been part of a larger picture in our strategy of building a gold company and increasing our production. So let's just talk about some of the recent steps we've done. So we'll dive in more about HGO and the exploration afterwards, but we announced Q1 results. So our first quarter, as you were pointing out, last year we dealt with the fires, and we still managed to maintain a very strong Q4. This quarter, we were in the early part of the quarter prior to COVID in January, we were actually dealing with floods. We were having all kinds of rain after the fires, floods. Then shortly thereafter, the pandemic comes, and now we're dealing with it. But despite all of those challenges, we managed to achieve just under 25,000 ounces, Mike, in production. And let's face it, let's remind ourselves here that a year ago, this company didn't even have a mill. This is our first year of production here. So all the things we've managed to successfully complete, Q1, we're sitting just under 25,000 ounces. And I've had a lot of bankers or others, analysts, tell me that the ratio right now is somewhere around 50% of all mining companies. And I didn't fact check this, but it's not hard for me to believe just looking at the news. Approximately 50% of the mining companies have removed their guidance for the year and have yet to even replace it with anything else. Whereas we're standing up here going, look, we're dealing with these situations. We're being very proactive. We have a very disciplined team. Our guidance still holds true today. Now, if there's any unfortunate event where the government comes in and shuts us down, then we'll deal with that. And we're actually proactively thinking that through as well. The what if scenarios. What if we do get called? It was the reason and rationale for us putting a larger stockpile in front of our mill here. Today we've got, Mike, we've got about 100,000 tons in front of the mill, and that was in preparation, proactively, in case we get a call where the undergrounds or our mining operations or the roads have to stop. We were doing everything we can to be proactive to ensure that we achieve that guidance and deliver. So our guidance today is 90 to 95,000 ounces for the year. Q1, again, 25,000 ounces. You multiply that times 4, we're at the high end of our guidance. As we're doing this, as we're delivering, it's important to recognize the efforts we have put in at managing and reducing our costs. We have been focused on our all-in sustaining costs since the first day I walked through that door here. And it's not something we'll ever let up on. We're going to continue on it. We've been focused on 4 areas. But if you look at the first 3 quarters since we've owned our mill and we're in production and sustaining our production, you will see 3 quarters in a row starting in the second half of 2019, 3 consecutive quarters where our all-in sustaining costs continually dropped quarter after quarter after quarter, despite all the challenges we have, fires, floods, and COVID. We are still delivering on our ounces and reducing our costs. Our target is to get to $1,000 US all-in sustaining cost by the end of the year and maintain that number. It's easy to get up, down this seesaw thing, but holding that number, putting in contracts in place, developing agreements with royalty holders, putting in all these steps into place are very critical to that sustainable number that allow us to forecast, project, and produce a life of mine plan very effectively.
Yeah, you certainly.
So let me just
go ahead.
Go ahead, Mike.
You certainly haven't taken your foot off the gas pedal, that's for sure.
No, there's no doubt. Look, so let's talk about the announcements recently. So Q1 numbers, an outstanding quarter. And just before I get off Q1, Mike, I just want to say that, when you look at our cash position, that's the best report card we're ever going to get. How much cash do we have? Are we depleting cash? And if you're depleting it, is there value added to it? Because many times it makes sense to spend money if you're going to create more value. And in our case, we've always been of the mindset that we want to be able to spend $1 of our shareholders' money and create $2 to $3 over that money. And you see that in the logic in the steps we've done. So let's talk about some of these steps. Q1, we ended the quarter with $38.4 million Canadian. That was up $4 to $5 million cash from the previous quarter. And look, Mike, that is despite paying in $5.3 million into hedges that we had. We had some legacy hedges that we had to buy into in Q1. It was 2,500 ounces per month, so 7,500 ounces per quarter. So that additional $5 million could have been in our bank, but look, there was a reason for those hedges to be put in place. The good news is this. Q2, our hedge position will be gone. We have approximately going into Q2, we had about 3,500, so about half of the ounces that we had in Q1 in a hedge position. And afterwards, we have no desire to hedge any more gold. We believe gold is in a very interesting position and that there's going to be a great opportunity for gold miners, gold shareholders, anybody who believes in gold. I think it's a very bullish time frame. So when you look at some of these things that we've done with respect to Spargos, that was one of the announcements. We bought it for 4 million Australian, then there's another 2 settlements of 1.5 and 1 million. That was using some of our cash. When I say using $1 to make $2 or $3, that's a great example where we provide ourselves with optionality and flexibility. Look, the initial JORC compliant resource there was over 4 grams. This is an exciting spot for us. When we bought that mill, we held that district. There were others, including that company, that were planning to use that mill in the future. But because we have so much operations, we don't have the flexibility to toll mill a lot. So Spargos was a big deal. Q1 was a big deal, Mike. And then we announced the phase 2 of Morgan Stanley. this, again, was always part of our strategy. When we started back in 2019, working on phase one of the Morgan Stanley royalty, in the back of our minds, we always believed that we could get to a deal with Morgan Stanley to eliminate all the NSRs in the legacy stuff, everything, and to remove the final 2% royalty that was on our area. So if you recall, in December, we announced phase one. We didn't call it phase one. We announced the renegotiation of Morgan Stanley royalty from approximately 7% down to 2%. And then we held on to some legacy NSRs for 11 years at 10,000 ounces a year. We've effectively now eliminated all the NSRs and the remaining 2%, opening up the door for future exploration in an 1,800 square kilometer district. Look, and the results are speaking for themselves. You start looking at some of the impact of our drill results, and you start applying mine plans and economics to these, and resource estimates and reserve estimates. When you remove the burden of that royalty, you certainly open up the door for so much more opportunity, Mike.
You certainly do. And I've been doing a little bit of research on the HGO land tenements myself, and I was quite intrigued by the amount of prospective areas you have on that property. But I want to get to that, but not quite yet. First, I want to talk about this proposed 11-to-1 share consolidation. You recently put it out through CDAR and your MIC, and you're putting it up for a vote. Can you kind of talk to us about the thinking behind that?
Yeah, sure. Look, this has been something that has been discussed internally for some time. This is a great example where a board of directors and an executive team are actually listening to our shareholders. And as you pointed out, that was in our management information circular. It's up for vote. We are letting our shareholders decide the best option for what they want in this company. We have had a tremendous amount of shareholders tell us, you must do this, you have to do this, because it allows a lot of other institutions to buy the stock once it's over a certain threshold, and that threshold is $1. Also, it opens up the door for many groups, whether it's institutional and even retail, that you can create margin accounts. Once the share price is over a certain threshold, you then have access to margin accounts. So this allows for a lot more buying or dry powder for institutions and even retail people. I actually got a call from an individual who said, what you're effectively going to do, if you guys decide to do it, and again, I will repeat, this will be a shareholder vote, a shareholder decision. So if our shareholders say this is what we want to do, then we once again will be listening to them. But that retail person called me and said, this is great news for me because you've just given me free money. And I didn't quite understand it, but after listening and calling a couple banks and doing some fact checking, it's obvious that that individual was correct, where he's now going to have access to a margin account that he wouldn't have had if we're below that threshold. So at the end of the day, this is a big decision for us. Most of our shareholders currently are in North America. We have been asked by our shareholders to do this. We've put it in there for a vote for our shareholders to decide, and we'll know what the results are after the AGM. So
I think it's a smart decision. I mean, obviously we've seen what's happened with such a large float. It's been an ongoing concern. So kudos to you for pulling the trigger on doing that. So HGO, you guys added Spargos when I think you already had 70 plus prospective targets that you could chase after on HGO. Talk about ambitious, Paul. Jesus, this is great news. But HGO in general, you guys just released some really incredible results from a few areas that were under my radar when doing my research. So talk to us about some of the exploration results, and then I'm going to pick your brain about some of the other areas of interest on the HGO land package.
Yeah, sorry, if I'm moving my face over, it's just because I'm taking advantage of technology here, and I want to make sure I read the exact numbers. I have them on another screen here. So
that's quite all right.
So let's talk about HGO. In phase one, Mike, we had identified 5 new areas with drilling after we did the phase one of Morgan Stanley. And those areas were Fairplay North, which, by the way, we're already mining in. So that's how near term. I get asked all the time, well, how realistic are these things, Paul Huet? Do you think you could actually mine them? Do you think they could become in a mine plan? And my response is simple. Look, we are already mining in one of them. Fairplay North was 1 kilometer from the mill, Mike. That mill was built in 2009. That ore has been there ever since. Why hasn't it been touched? The answer is simple. With the type of royalties and the burdens that were on there, people were not willing to mine that at those types of burdens. With the metal price, with the currency exchange, and no royalty, these things become extremely attractive. So Fairplay North, let's talk about, that's one. Mouse Hollow, Hidden Secret. Those are 2 satellite open pits that are on the same road to Baloo. Initial work now, we've have probably around 20 holes ourselves into this, suggests that this could potentially be 1 pit. And I'm excited about it. We're excited about it. It's premature to make that decision, but it sure is encouraging to know that it has the potential to circle together into 1 pit, which would be a much larger size pit. So Fairplay North, Hidden Secret, Mouse Hollow. We've got Aquarius. Aquarius is just south of the mill, Mike. We have intercepts in Aquarius. I don't have them in front of me here, but they're over 600 gram over 2 meters, 225 gram over 2 meters, some 68 gram over 2 meters. It's obvious this is right up my alley. This is the kind of stuff I've mined my whole career. Narrow vein, high grade. Aquarius has a resource today of over 19 gram. It's just south of the mill. The mill was built for the Trident mine. Trident was an underground operation. It produced over 1 million ounces of high grade. So it's no surprise to us that directly south we have this opportunity for another underground. So we will be following up on that in the near future. So that's the 4th. Then we have the 5th one, is that geophysics. As soon as we announced the phase 1 Morgan Stanley renegotiation, we spent about $100,000 to $150,000 on some geophysics that had not been done in this district for almost 2 decades. We have identified, the geophysics have identified, just north of our mill, north of the Trident mine, a 5-kilometer structure that has no drilling in it. That is quite exciting for us. Now that's early stages, but it's 5 new targets since phase 1. Now, recently, we've announced the Palaeochannels and some of the other stuff. So these are some pretty exciting things that we have that could be injected into that will be injected into our life of mine plan. So let's talk about the Palaeochannel stuff. We have Mitchell and Pioneer that we've identified here in the near term here.
Mitchell has 4 distinct zones within it, and that's south of the challenge pit, Jupiter, Mars, Venus, and all those satellites of the challenge pit, correct?
Yeah, that's right. So look, the Palaeochannels, we have Mitchell to the west. We have Jupiter, Pluto, Challenger. They're all within that 7-kilometer strike. And then south of that is Pioneer. So look, the Palaeochannels is something that's very different and unique. This is a sedimentary area here, Mike, that has the potential, and I want to qualify this. I want to be really clear. I'm not saying, I don't want readers or people to watch this to say, well, Paul Huet said. Paul Huet is saying this. I'm saying that there's an opportunity here, and a very unique one. And we need to do some work. But initial thinking is very, very strong that this Palaeochannel could potentially be pumped from the source. So whether it's Pluto, Jupiter, Challenger, Mitchell, all those areas, we could potentially pump our material from there into our plant. What does that mean? When you think of our constraints today, we're at 100,000 ounces per year, first year. Some of our constraints and our bottlenecks are our mill. We're looking at ore sorters. We're looking at the front end to grow engineering. But these paleos, just think of it, Mike. If we are able to pump this to the mill, it means no trucking. It means it bypasses the front of the mill. The crushing system in the mill gets bypassed. This goes into the back end of the mill, freeing up some allowing us to increase our productivity. So for us, this is much bigger than just the exploration success we've had. If these paleos do work, and look, you're seeing the drill results as we're seeing. These are fresh, hot off the press, but some very, very good results here. Some of them that could be open pit, some of them that could be underground, all pointing towards the new Karora resources that we're going to be called Higginsville project. When you start looking at all these areas, the 5 that I mentioned before, these new 3 ones, these are all going to find themselves into our life of mine plan here in the near future. We have put together a plan for 24 months in front of the mill. This will extend that plan, no doubt about it. We're putting our own resource calculation and reserve calculation for Higginsville. The one we've been working on has been the historical one from West Gold. We'll have one out by the end of the year, Q4, and I know everybody would like it sooner. So would we. Look, I'm the first to say I'd love it sooner, but we are working off information that we believe is quite good from West Gold. Adding all the new information that we're drilling is going to be quite exciting to determine where we mine, how we mine. We're going to prioritize things. We just have much more flexibility and optionality. Now, the decision to circle in Spargos, look, that was a no-brainer. When you consider the amount of ounces and the cost per ounce, it's so cheap to buy this thing at 4 million Australian plus the additional 2.5 million, $6.5 million Australian, and the other 1.5 million that we have to pay for it is only if we double the resource. So this is very exciting for us as we continue to look forward into the future of growing our company.
So you're going to kind of bottleneck yourself, as you said, at some point here. I mean, you have so many prospective areas that you're targeting right now. At some point, are you looking at doing a full-blown mill expansion, or would you be looking to maybe acquire a secondary mill to supply to meet the demand of the feed that you're going to put in front of the mill? I know this is very forward thinking, but I mean, you look at all these prospective pits and the writing's on the wall. You're going to have to do something.
Yeah, look, Mike, I will take that any day of my life. I've been mining 33 years now. What a problem to have for someone to finally reach out to me and say, Paul Huet, the biggest problem we have is we have too much ore in front of our mill. Oh my gosh, what a blessing. Thank you so much. All my career, it's been the opposite. We have this mill, we cannot feed it. It's a 4,000 ton a day mill. We can only feed 2,500 tons a day. We have to shut it down for a certain amount of time. This is the greatest problem we could ever ask for, and we will resolve it. There's all kinds of things that we've been very proactive from day one. We always hoped and expected to have this challenge in front of ourselves. So again, ore sorters, that could reduce throughput into the mill by taking off 20 to 30% potentially of tons into the mill, replacing it with higher grade. Palaeochannels, the bottleneck is the front end of the mill. So if we could add 20 to 30% to the back end of the mill, increasing production. We are doing some engineering work on the front of the mill, and we've been very transparent about that from day one. So this is, from my perspective, a CEO who's been such an operator my whole career, it's the greatest problem we can ask for. We just need to sit down, technically map it out, figure it out, and find out alternatives and solutions. So having more optionality, flexibility, areas to go to is the best recipe for success for our shareholders. If you look at our predecessor, Mike, what did they challenge with? Why did Higginsville struggle? Obviously, it struggled because they couldn't feed the mill. Let's face it, they were only able to feed the mill at half capacity. They were using toll milling to subsidize it. We don't have to do that. They were saddled with a huge royalty in these areas. No drilling had been done in 7 years from that company because they weren't going to drill in a district where this royalty was so excessive. All those things are wiped out for us. So the future is exciting for us and our shareholders. There's absolutely no doubt. This area has more gold. We've got a strong team to start unlocking this, to start discovering it. The problem of having too much ore in front of the mill, biggest blessing I've had. I haven't had that in my career, actually. Again, even my days at Klondike's, it was always, we were short at the mill. My days at Newmont, we were short at the mill. my years at Kinross, it was, we can't feed the mill. So you can't ask for a better problem. We will overcome it.
Yeah. So those southern Palaeochannels, I've noticed they kind of all come to a stop, or the previous mining operations all came to a stop, roughly right around the south end of Challenger. Now you're finding Pioneer, but these extend right into Lake Cowan. There's a huge portion of these Palaeochannels that are still open to exploration, is there not?
Yeah, no, look, you're 100% correct. And I would say that if you even step back, think of the Palaeochannels, but think of everything we have. There isn't one area that we're mining in Higginsville today that we know of that is constrained by a fault, or everything is constrained by drilling. Look at, let's you started with the paleos. You're 100% correct. This is only constrained by the information we have.
Yeah.
More drilling, more information will give us more results. But let's look at Baloo. When we bought Higginsville in June of 2019, we started with Baloo that was supposed to end, it was supposed to be a 6 to 7 month pit. We've just announced results here this week, Mike, that suggest that not only has Baloo continued to extend, we're talking 2021 now, it's already a year beyond what it had originally been expected. But we're now looking at some targets within Baloo that suggest it could become an underground mine. At the bottom of the pit, we could potentially have some grades that would source an underground mine. So putting all this together, and our optimal blend would always be trying to mine maybe 2 open pits and 1 underground at the same time, and planning that out and scheduling that's great for us. So as you point out, many of our targets are just constrained by drilling. And again, you can't help but use the best example, Baloo. We've said it's constrained by drilling. Every time we drill, we add to it, we add to it, we add to it. Hidden Secret, Mouse Hollow, we continue to drill in it. It appears as though those things might connect. So a lot of the information we have is constrained by drilling. So that's extremely exciting for us.
So Baloo is part of the Lake Cowan group. You also have Monsoon and Nanook that are within that trend. Are these points of areas that you're going to be looking at in near term, or do you kind of have your hands full with all these other targets that you have right now?
Yeah, so right now we've got an active drill program in about 6 different areas: Baloo, Jupiter, Mitchell, Pioneer, Aquarius. Those are where we're focused on now. Look, we haven't even put together a plan yet to drill that 5-kilometer strike that's just north of the plant. That's a real structure. That's a really prospective target for us. So there's just a lot to do. We have $10 million in drilling this year, predominantly most of it at Higginsville. We will probably look at increasing that, again, to the theory of $1 should be viewed as $2 to $3 for our shareholders. Anytime we've been drilling, we've had some good success in our areas. So increasing our exploration dollars is likely something that we would strongly consider, because when we put together these budgets, actually, in fourth quarter 2019, we used a metal price of $1,400 US, and where is it today? It's anywhere from $1,650 to $1,700 an ounce. So because of that, and we're adding significantly more cash to our balance sheet by removing the hedges, removing the royalty. I can't help but remind people that this is still our first year. Like, when you think about it, we're being compared to companies that have been around 2 to 10 to 20 years. This is our first year as a gold operator, having our own mill, putting together things, people first and foremost, delivering, increasing productivity rates at every level, efficiencies, mill productivity rates, everything is working in our favor. We've got a strong operational team that are delivering on all cylinders here.
So you said you're going to increase your exploration dollars, or more than likely will be. Can we expect any of those exploration dollars to go into Beta Hunt, some extended drilling in that operation?
Yeah, look, there's no surprise that we did a big exploration program last year at Beta Hunt. Let's face it, we did a large one before acquiring Higginsville, right? We started at Beta Hunt, Mike, with about 400,000 ounces in measured, indicated, inferred. That was all three categories, and I want to be clear about that.
Yeah.
We did, what was it, about $6 million. It was a big program, 40,000 meter drill program at Beta Hunt last year, which increased it by almost, measured, indicated, and inferred again, 1 million ounces. So we had a tremendous growth in 2019 at Beta Hunt here.
I know you're busy, so I'm going to cut this one short now. I think we've covered all the bases, but let's do this again soon. It's been too long since we caught up last time.
Okay, you take care.
You too. Cheers.
All the best.